Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. The World Bank is out with a new outlook for global growth this morning. They expect global growth to slow and then for the third year in a row to 2.4%. That would be down from an estimated 2.6% from last year. As interest rates remain high around the world and central banks try to bring inflation down, those higher interest rates expected to continue filtering through to global economies, suppressing growth. At the same time, global trade is expected to remain weak this year. For more insight on this report, I want to welcome into the program Deputy Chief Economist of the World Bank, Ayhan Kose. Ayhan, thanks so much for joining me. It's great to see you.
Thank you. Great to see you, Jennifer.
Ayhan, given your outlook, do you believe that central banks can successfully bring down inflation without causing a recession globally?
We are not expecting a recession at the global level this year, and I think that is fantastic news. When you think about what happened over the past 2 years, we had a barrage of shocks. Despite those shocks, and of course, decade-high inflation and the reaction of central banks by increasing interest rates to unprecedented levels over the past 40 years, we did not have a major financial crisis. We did not have a significant downturn. So the global economy has shown remarkable resilience. Yes, growth is slowing, but we think that in all likelihood, we will see a soft landing for the global economy.
So while you do expect a soft landing, you expect growth will remain well below potential absent some sort of corrective action from policymakers for the rest of the 2020s, right? What's really driving that?
So there are some good news, the resilience and having still good growth, I think these are good news. At the same time, when you look at the bigger picture and put these growth numbers into historical perspective, you realize that over the 2020-24 period, global economy has registered the weakest growth rate in a half decade. And you look at the growth number this year around 2.4%. That's around 0.8 percentage points lower than what we had prior to the pandemic on average in 2010s. For emerging developing economies, almost 1 percentage point lower growth this year than the average of 2010s. The big challenge around the world, of course, investment remains weak, investment growth numbers, and trade remains weak. And you have way too much uncertainty between geopolitical tensions and fragmentation of trade and investment networks.
All right, well, you talk about downsides to growth in this report, and chief among them is the conflict in the Middle East and the potential to push up commodity prices. So I'm wondering how that factors into the outlook for inflation and whether we could see headline inflation jet back up towards the middle of the year, and if that could seep through to already stubborn core inflation, and what could that mean for global interest rates?
So we are obviously worried about geopolitical tensions. That is number one in our risk matrix. When we think about all the downside risks, we used to focus on, financial stress because of high interest rates. Now, given the kind of the war, Russian invasion of Ukraine, and then now the conflict in the Middle East, and the other geopolitical tensions associated with trade, the fragmentation of investment networks, we are focusing on geopolitical tensions. In the context of escalation of conflicts in the Middle East or Eastern Europe, obviously we worry about the possible increase in energy prices and the impact on inflation. First, headline inflation, and through second round effects, core inflation as well. Having said that, our baseline implies inflation will continue coming down, not to the levels I think central banks are going to be comfortable with. We will still have a number of countries having inflation rates by the end of this year above their targets. But we are optimistic about the direction of inflation, and bearing these downside risks, we see that inflation will continue coming down.
All right, well, given your outlook for inflation, specifically focusing here in the U.S., Curious whether you think the U.S. Federal Reserve's policy prescription for this year, the median projecting now 3 rate cuts, is the right one.
Federal Reserve has managed the tightening cycle very well so far. There was a little bit of delay at the beginning, but since then they have been quite aggressive in terms of increasing interest rates and sending the type of messages necessary to guide the financial markets. Going forward, they are still going to look at the incoming data, adjust the policy, and obviously inflation peaked. The big challenge is to how they are going to manage this persistency we see in core inflation. Interest rates will come down sometime this year, probably in the second half, depending on the direction of activity and inflation. But we are expecting the U.S. central banks to be very careful in its interest rate decisions and not to go easy before having, this conviction about sustained decline in inflation.
Also want to ask you about China because you expect growth in China to slow to the lowest level in 30 years. I have 4.5% here in my notes. That would be down from what you expect to be just over 5% for last year. All of this also as they're dealing with issues in the property sector. Does the World Bank believe that the issues in the property sector will remain contained as we've seen so far? And if not, how does that bode for global growth, given that China is the world's second largest economy?
China is a major economy. It has substantial spillovers to other economies, especially commodity exporters. As you said, the growth this year will be the weakest over a long time period, except the pandemic period. Now, the Chinese policymakers are well aware of the problems in the property sector. They have already undertaken certain measures. We think that the fallout from the property sector will remain contained if Chinese policymakers continue, this vigilance when it comes to financial sector implications of, the challenges we see in these real estate companies. Having said that, beyond the cyclical issues, China is facing some serious structural issues in the context of demographic challenges, in the context of overinvestment in certain sectors. So growth will be slower this year, even slower next year. But we are expecting a smooth transition to slower growth, more manageable, more sustainable growth in China.
All right, well, we'll have to leave the conversation there. We are out of time. Always so much to talk about with you. But Ayhan, we look forward to talking with you again soon.
Thank you.